Imagine waking up to find your life savings wiped out overnight. In 1929, millions lost almost everything in the Great Depression. Or in 1998, a genius hedge fund imploded, nearly crashing the global economy. That's the real stories of the markets we are all part of. Though, there are ways to counter the market volatility and actually beat the system. No matter how bad the situation is, there are always winners. 20th century was not an exclusion. So let us check these people. So what is even hedging, you might wonder? The word hedge comes from Old English, referring fence of bushes that enclose fields. It has been started to use mostly in finance with the rise of brokers in the 20th century. Hedging is an investing strategy that aims to reduce the risk of the portfolio. Hedging can be done by expanding the variety of assets, taking an opposite position, or putting money into risk-free assets such as bonds and cash. There are no perfect hedges, but ideal ones should keep the money steady, whether stock crashes or rises. Think of it like surfing on the waves. However big the waves are, you try to stay on control. We know that in today's world, there are all kinds of investment tools, financial plans, and unprecedented amount of liquidity. When did all these started though? For that, you need to understand why it was needed on the first hand. In the early 20th century, markets were brutal. Booms and busts hit hard, with almost no safety nets. World War One wrecked the economies. Later the war, markets were speculated heavily with no major force to stop it. And then, 1929 Wall Street crash came. Major stocks lost up to 90% of their value from the peak. Banks failed by thousands and Great Depression wiped out jobs, savings, and entire fortunes. Most small investors had no real tool to protect themselves. Hedging existed but was basic and limited. People tried to diversify their assets, come out debt free, hold physical assets like gold or land. No asset was safe from this huge crisis though. Only until 1940s things got back to where they were for the most of the world. That desperation set the stage for something revolutionary in 1949. Alfred Winslow Jones, a socialist and financial journalist. He is widely recognized as the father of the hedge fund industry for launching the first modern hedge fund in 1949. Oh, and he was a socialist and Soviet sympathizer. He fought for humanitarian rights, global equity, poverty reduction, and mutual aid. Maybe not the guy you were expecting, but he really has an interesting life. But his story is for another video. Let's focus on the hedge fund he founded. A.W. Jones launched in January 1 of 1949 with only $100,000. They profited by longing undervalued stocks and shorting overvalued stocks. Oh, now that it's relevant to say, longing means betting an asset to rise, while shorting means betting an asset to lose. By doing something that no one was doing, they arose with their returns while charging up to 20% fees. From 1949 to 1968, they delivered 5,000% cumulative returns, annually 30%. For the record, S&P delivered only 358% in this time gap. Aside from their massive success, they also opened up the next chapter of the finance. After all, they invented hedge fund blueprint, proved active management superiority to the buy-hold strategy, centralized risk oversight with portfolio managers' autonomy, and birthed $4 trillion of industry. It stayed niche for years though. Only a handful of people were part of this fund, but Jones planted the seed. Hedge funds were born as tools for protection and outperformance in the mid-1900s. The 1970s were a nightmare. Stagflation, high inflation peaking near 14%, stagnant growth, oil shocks from OPEC embargoes, and unemployment. Stocks suffered the last decade. The S&P 500 nominally positive, but down sharply after inflation. Bonds also lost purchasing power. During such a bloodbath, hedge funds rose up. Hedge funds use global macro strategies. They bet on big picture trends like currency devaluations, interest rates, and commodity swings. Some shifted to countercyclical assets or diversified aggressively. With these new hedge funds and their massive success, another era began for the world of finance. The time between 1980s and 2000s were the golden age of betting on directly global economic events, especially after the abundance of gold-backed US dollar system. On those times, George Soros and his quantum fund led the pack. Soros founded it in the 1970s, but hit legendary status in the 1980s to 1990s with massive constrained trades. He profited from currency fluctuations in the 1980s. One of his biggest bets was when he shorted over 10 billion in British pounds in 1992. He predicted that UK couldn't defend the pound's value. When the Bank of England raised the interest rates but failed to defend the pound, he profited 1 billion in a day. The fund broke the Bank of England on its own. Other macro masters shorted overvalued assets during crashes and rode bull markets with leverage. These funds delivered equity-like returns with lower volatility in many years. They also popularized aggressive hedging via derivatives and short. There are spectacular stories like this throughout the late 1900s, but when they go wrong, it's fatal, not even just for them, but also for the entire global economy. In 1998, A famous hedge fund called Long Term Capital Management, run by Nobel Prize winning geniuses, looked unstoppable. They made bets on tiny price caps and borrowed crazy amount of money to make them bigger. Their major mistake was when the Russian currency was devalued. One of their bets blew up. They lost $4.2 billion, 52% of their capital, in weeks. They were so big that if they collapsed, they could have turned the markets into hell. With the help of Federal Reserves, the collapse was taken into control. Hedge funds provoked huge debate. People called them destabilizing. After all, from what we have seen, Soros currency attacks hurt economies, and LTCM risked systematic meltdown. High fees, secrecy, and exclusivity drew controversy. Many saw them as elite gambling. Yet their legacy is massive. They innovated risk management, they pushed regulations and developed better oversight post-crisis. They made the markets evolve from manual floor trades to today's apps, ETFs, and options. Thank you for watching my video. If you enjoyed, please like and subscribe. Take care.